Hello everyone. So in today's video we're going to discuss the concept of government securities. Now you've also had a few questions which have been asked on this topic in the prelims exam, and we're going to be discussing two of those questions in today's video. So let's get started and understand what are government securities at a basic level. So government securities are basically debt instruments, that is, they are mechanisms which allow both the central as well as the state governments to borrow money from investors. So they are a mechanism which allow the governments to borrow money so that the government can finance the excess of expenditure which the government may have over its earnings or revenues. That is, they are a mechanism which allow the government to fund its physical deficit or finance its physical deficit. Now, a key feature about government securities is that government securities are tradable debt instruments. That is, an investor who has purchased these securities need not hold these securities up till maturity. That is, they can be even sold before maturity. Now, the securities which the government issues are also commonly called as gilt-edged securities. Now, the word gilt-edged security means that these securities are almost risk-free because the government is least likely to default on its payment. So you can never, or you can almost expect that the government is never going to default. That's why government securities are also referred to as gilt-edged securities. Now, the government securities which are issued are of two broad types. That is, based on the tenure or duration, they can be categorized as short-term government securities, which are also referred to as T-bills or Treasury bills. Now, your Treasury bills are issued for a duration of less than 1 year. Now, we have a detailed video if you want to understand the topic of Treasury bills. Now, it's in the playlist and it's the video number 3 in the playlist if you want to know more about the concept of Treasury bills. But right now, for the sake of this video, we'll talk about two things, that is, the tenure up to which Treasury bills are issued. So you have Treasury bills which are issued for 91 days, 182 days and 364 days. So that's one feature of Treasury bill. The second feature which is important for today's discussion is that Treasury bills are issued at discount to face value. That is, Treasury bills are a type of government securities which do not pay periodic interest. So what happens is that an investor purchases these securities at a discount and he gets the full value on maturity. So let's say an investor buys a Treasury bill for 97 and he gets rupees 100 on maturity. So the difference of 3 rupees is the return for investor. So Treasury bills do not pay periodic interest payments. The other type of government securities which are issued are the ones which are issued in the long term. That is, they are issued for more than 1 year. Now, the securities which are issued for more than 1 year are referred to as either government bonds or they are called as dated securities. So government securities which are issued for less than 1 year are called Treasury bills, and if government securities are issued for more than 1 year, they are called as either government bonds or dated securities. Now, an important feature about government bonds is that unlike your Treasury bills, government bonds typically pay a fixed periodic interest and they also return the principal amount on maturity. So let's say there is a government bond which the government is issuing and it has a face value of rupees 10,000 rupees, and the government is saying that it will pay an interest of 7%, and the government is borrowing via this government bond for 10 years. So what the government is going to do is that for 10 years the government is going to pay a periodic interest of rupees 700. So 7% of 10,000 is 700. So for 10 years the government is going to make an interest payment of 700 every year, and in the 10th year, at the end of the 10th year, the government will return the amount of 10,000 which it had borrowed. So government bonds, unlike your treasury bills, pay both periodic interest and they also return the principal on maturity. Now if you talk about which government can issue which type of government security, so the central government is allowed to issue both type of government securities, that it can issue short-term treasury bills as well as the central government can issue government bonds, which are the long form of government securities. However, if you talk about the state governments, they are not allowed to borrow in the short term via treasury bills. That is, state governments are not allowed to issue treasury bills and they can only borrow in the long term. That is, they are only allowed to issue government bonds, and these government bonds which the state governments issue are called as state development loans or SDLs. So these are called as state development loans. Now a point in regards to SDL which I want to mention is that in the video on treasury bills and also in context of government bonds is that these form of securities, government securities, are eligible both as a form of SLR for meeting the regulatory requirement of banks as well as for being used as a collateral if banks want to borrow from RBI under the repo or reverse repo facility. Similarly, the SDLs which the state governments are issuing are also eligible for being used as mechanisms to meet the SLR requirement of banks as well as for liquidity adjustment facility. That is, they are eligible collateral for borrowing operations which take place between the banks and RBI. So SDLs which are issued by the state governments also have this facility which treasury bills or government bonds which the central government issues have. Now if you talk about government securities or government bonds, these are issued by RBI on behalf of the government. So you have RBI on behalf of the government which issues these government bonds, and the way RBI issues these government bonds is that RBI conducts an auction on a centralized platform of RBI which is called eKuber, and it calls for different participants to participate in this auction and bid for government securities, and typically depending on the amount the government wants to raise, RBI selects those bids which are the most competitive bids. That is, those investors who are willing to lend at a lower interest rate are the ones who get selected in this auction which RBI conducts. Now if you talk about the investors who typically participate or purchase these government securities, the first category are your institutional investors. So you have commercial banks, then you have primary dealers which we'll discuss in another video, and you have financial institutions such as insurance companies and mutual funds which participate in buying government securities because these are considered as low risk instruments. So this becomes an important portfolio for different institutional investors. In addition to institutional investors, RBI has also allowed or RBI has promoted investment by individual investors in government securities. And in order to do that, RBI has introduced a RBI Retail Direct platform. So via this, you can have individual investors who can open their retail direct gilt accounts with RBI and they can participate in purchase of government securities. So basically, even individual investors besides institutional investors are allowed to purchase government securities. Now in addition to Indians, you have foreign portfolio investors also who can by these government securities. Now, in order to ensure financial stability in the overall economic system, RBI, however, does prescribe limits on the amount of government bonds or SDLs or corporate bonds which foreign portfolio investors can hold. However, the key thing out here is that foreign portfolio investors are allowed to invest in government securities. So these were the concepts we wanted to cover in context of government securities. Now let's move on and look at the two questions which were asked in the prelims. So the first question which was asked in prelims 2018 was, if you want you can pause this video and quickly go through these statements, and that is what I would suggest. So I'm hoping you would have paused, and now let's look at all the three statements. So the first statement is that the Reserve Bank of India manages and services Government of India securities but not any state government securities. So is this statement correct or not? Well, this statement is not correct because RBI acts as a debt manager for both central and state governments. So RBI manages and services the securities both of the central government and the state government. So this statement is not correct. The second statement is treasury bills are issued by Government of India and there are no treasury bills which are issued by the state government. Now this is a statement, or this is a concept we've learned in today's video, and this statement is correct. That is, state governments are not allowed to issue treasury bills. The third statement is that treasury bills are issued at a discount from par value or face value. Now this statement is also correct because treasury bills are discounted securities which are issued at a discount and redeemed at full value. That is, they do not pay any periodic interest. So we can see that statements 2 and 3 are correct. So a correct answer becomes C, that is 2 and 3 only. So this was the first question which was asked in prelims 2018. Now let's look at the second question which was asked in prelims of 2024. Now this question was, in India, which of the following can trade in government bonds and government securities? So you have three entities which are mentioned: insurance companies, pension funds, and retail investors. So now this question is clearly testing your knowledge if retail investors are allowed to trade in government securities, and we just learned that retail investors can invest in government securities. So RBI has a dedicated platform which allows that. And in addition to that, we know that you can have insurance companies which invest both in government bonds and government securities, and similarly pension funds. So out here all the three statements are correct. Now your answer out here becomes D, that is 1, 2 and 3. So all these three statements are correct. So this is all we wanted to cover in the context of government securities. I hope you liked this video. If you did, follow the channel and do check out all the content in regards to UPSC economics. Thank you so much for watching.